very warm welcome to the Friday morning session. My name is Eleni Giokos. I'm with CNN International. Today we're going to be talking about banking on youth with a big focus on financial inclusion and how digital solutions can change entrepreneurship on the continent. We're going to try and take the conversation forward. I think financial inclusion has been a concept that has been discussed on what is happening in Africa for many years now, because it can have a significant impact on changing the notion of inequality and, of course, inclusive growth as well. But it's not just about opening up bank accounts. It's not just about the simple mobile money transactions anymore, or banking the unbanked in the rural areas and creating the bricks and mortar behind financial institutions. It's about creating an impact for socio-economic change, and importantly, also focusing on growth. This cannot be done if entrepreneurs don't have access to credit, if they don't have the support from financial institutions. And the numbers are still startling. On the continent right now, only 34% of adults have access to bank accounts. It's up around 10% since 2011. It's big growth, but it's not good enough. Because it's not just about having a bank account. It's about people having enough money to want to open a bank account. It's about barriers to entry. It's about ensuring microfinance exists. It's about supporting entrepreneurs as well. Big topic of conversation, banking the youth, financial inclusion, and giving the support, of course, to entrepreneurs as well. I'd like to introduce my panel of experts this morning. I've got Uzoma, Dozie, the General Managing Director and CEO of Diamond Bank, Stephen van Coller, the VP, Digital Services, Data Analytics and Business Development at MTN, Ineke, Bussemaker, CEO of National Microfinance Bank in Tanzania, and we have Aisha Pandor, Sweep South, as well as Darlene Menzies, the CEO of FinFind. I welcome you all. Thank you very much for joining us. Very important conversation to be had, and of course you all have your pulse on the things. Stephen, let's focus on what we're seeing right now on the continent. Uzoma, I'd like to start with you. We were talking offline a little earlier about financial inclusion and what it means to have a bank account on the continent. And it's not just about the simple things, it's about taking a step forward. How are things evolving in Nigeria at this point in time, and how can we make technology and digital solutions work?
So when I to put it in perspective, when I started banking about 25 years ago, I think to open a bank account, you actually had to come into the bank to do that. And so, so the number of customers you had and the number of transactions you did depended on how many people actually came into a bank. Now, fast forward to today, what have we done? We actually turned it upside down. We're actually now taking banking into, so we're actually creating solutions to enable people open accounts by themselves through mobile, or we're sending agents into the marketplace to also show people how to open accounts with their mobile phones. So what we've seen is that we've actually had to change the way we do our banking to fit it around the people that we want to open bank accounts with us. And our philosophy, part of our perspective is there too. First of all, we have to provide solutions that are cost effective for people at the bottom of the pyramid. Secondly, we have to also provide a reason for people who have actually excluded the banking system from actually being part of their life, because one of the reasons why people don't open bank accounts because it's not convenient at all. So those two perspectives are what we're looking at. But now it took us 23 years to acquire 7 million customers, and in the last 2 years we've actually doubled that through using digital financial services. People actually opening accounts by themselves in different locations in Nigeria.
So making things easier, essentially.
Exactly.
Stephen, what's fascinating about mobile money transfers, globally only 2% of the adult population actually use this platform, but in Africa it's around 12%. So telcos have a really big role to play. How are we going to take that conversation forward about just being a mobile money transfer and putting it to work?
I think this is a big topic, but you can have a look and see just across Africa the different levels of success. So, and I'm going to be a little bit controversial here because I have our partner in Nigeria, but if you have a look at Nigeria, it's a bank-led model, so the government's trying to create a financial services, they're trying to replicate legacy banking on a digital platform. You've got a very low take-up, 2 or 3%, I think it is growing. If you have a look on the other side, where a Uganda or a Kenya have done what I call the telco-led model, so they've tried to create actually a mobile money class. You've got much bigger take-up. We were talking earlier about Kenya and M-Pesa. Stats are 96% of households have a mobile money account or an M-Pesa account. And if you approach it differently, you get different results. We've seen in Mozambique over 3 years of M-Pesa there. The last time I was there last June, they'd already, in 3 years, they'd overtaken the local state bank in terms of take up in accounts. And I think this, for me, is the fundamental difference. Why have mobile companies, and I'll use South Africa as an example because we're here, but MTN, for example, has got 26 million subscribers, whereas banks like Barclays, Absa, etc. have got 8 million subscribers in terms of accounts. Why is there that big difference? How can a mobile company deal with so many people and yet a bank can't? And the answer comes in the fundamental cost around regulation, how we set up legacy systems. Banks were set up in the past for the top end of society, so they want to do big transactions and they want clients who've got lots of money, not clients who've got very little money and do very little transactions. And so if you set up a system that tries to emulate a legacy system, you're going to start top down. If you want to get financial inclusion, you've got to start bottom up. And that's the beauty about digital and computers, is it doesn't mind whether it's $1 or whether it's $1 million. It just does the transaction because it's the same electronic
Uzoma,
pulse.
do you mind if it's $1 or $1 million? You're a banker, so you're obviously going to mind.
No, so I mean, my take here is that if it's bank-led, if we use traditional banking, you won't reach the population that you want.
Yeah.
If it's telco-led, it will be substandard financial services. So what you have, so mobile money is just a glorified money transfer. Full digital financial services allows you to save, access credit, get information about customers, and it's actually sustainable into the future. So I think it has to be a collaboration where you bring the tech from the low-cost deployment from telco and the banking knowledge and putting it together, which is actually what we're doing in Nigeria.
So Ineke, in Tanzania, it's even lower, in terms of banking penetration, around 15% of adults. Tell me about the changes that you're seeing happening on the ground, and we're talking about legacy institutions versus leapfrogging that and going into a more digital space. Is that going to work in the Tanzanian market?
Well, it is working right now. And I think, to me, the secret of success is move cash into digital. And that is what the banks are all doing. 70% of the economy in Tanzania is currently cash, informal economy. And cash leaves no history, and if you pay and do everything in cash, you never build up any history that can provide you with any credit. So what we're now doing, and I'll give you an example of what NMB is doing, we provide mobile financial services. So very quick and easy, cheap to open bank accounts related, linked to mobile services. We go into the fields. The example right now is maybe with farmers. We had a big cashew season. The government said cashew farmers from now on have to have a bank account to receive the proceeds of their cashew sales. So our teams went into the fields, went to the farmers, opened more than 30,000 bank accounts for the farmers, who then, after they sold their cashew crop, were all able to receive the proceeds on a bank account. So within a very short period of time, we were able, first of all, to raise a lot of deposits, take a lot of informal money, informal cash into the formal economy. The benefit for these farmers is that from now on, every year, they can prove to the bank the amount of cashew sales they've been able to do, and next year the bank will be able to provide them with a small input loan based on the fact that they've built up some credit history. So to me, the essence is changing the cash into digital. The banks have a big role to play. It's not just the payments, it's building up the credit history, but it's also making it very accessible and very easy for customers to use. And actually, digital is easier than cash in many ways. If you are out in the fields and you have a mobile phone and you can do a transaction, you don't need to walk 10 kilometers to the nearest ATM. So I think it's happening big time. See where we were 10 years ago. Nothing, no mobile payments, not even ATMs in Tanzania for that matter. And see where we are now, and I can see us in the next 2 to 3 years more than doubling, if not quadrupling, our number of customers using digital financial services, and that will enable to actually get more credit out.
Yeah, and I mean, that's an important point you mentioned is, of course, the credit history portion as well. Yeah. Aisha, you know, as an entrepreneur, someone that started from nothing, tell us about some of the barriers to entry that you experienced, and obviously being in South Africa, it's a lot easier to access financing relative to our counterparts in the rest of the continent, but it's still tough.
It's still tough. So my experience was I'd graduated from university with a PhD, and before starting my business, but because of not having had a strong credit history as a starting entrepreneur, I wasn't able to get a loan from the bank. So, you know, even as someone who had fairly strong credentials, it was still difficult to, you know, to get help from a bank in terms of accessing finance. And so I ended up going the VC route and, you know, and getting private funding for my business. But then our business Sweep South also deals with, so it's a platform that connects homeowners with domestic workers. And we deal with domestic workers in South Africa who actually, for the most part, are banked. But you know, their behavior with banking is that they will get money and immediately withdraw that money because the cost of transacting is so high. And so, you know, to be paying a transaction fee on, you know, a 50 Rand that comes into your bank account, it's just, you know, paying 10-20% of that on transactions is just not feasible. So what happens there is that people, yes, they do have bank accounts, they are transacting, but then withdrawing that money and then what they're doing with that money and the circulation of that money is all happening offline. So I think it's about access, but also about the cost of transacting and people trusting in banks. So you can improve access, but it's also got to be cheap for people to transact.
Darlene, tell me about how you link entrepreneurs and SMEs to banks and financial institutions and bringing those two worlds together.
Yeah, I think when it comes to entrepreneurship, the whole issue of financial inclusion is one of the things that Aisha just said is around access to finance and credit history, and how banks look traditionally at business, and in terms of digitizing and where we're going, how there are alternate scoring mechanisms that actually are needed for entrepreneurs. The average entrepreneur typically has a bad credit record personally because they borrowed from everywhere to get to where they are. They may not have a mortgage, they've never had a student loan, they've never used a credit card, so all the traditional things that a bank would look at to be able to give them credit, they don't have. But nowadays, alongside what's happening in terms of the whole mobile banking side, we've also got a whole alternate scoring, so social media data and how that's being analyzed. The way you use your phone is becoming a proxy for your lifestyle. So if you start to analyze that data, and so there's a lot of good studies and a lot of piloting that's being done around how we can start to get money to entrepreneurs that previously couldn't get money. And then it's also around financial literacy and financial readiness. And I think that if banks and corporates start to pay more attention in those areas, we'll start to be able to help more entrepreneurs, create more jobs, change the economy, and I think that then, you know, filters back into all of what we're talking around banking and mobile. It's not just about transactions; it's very much about how we able to give loans to entrepreneurs,
and
startups.
at the right rate as well.
Absolutely,
because the interest rate is obviously very important.
Yeah, it's one of the things we're doing. We've got a product that takes all the lenders, puts them into one base, and then an entrepreneur can come in and actually see who they match with. So now they can actually start seeing the banks against each each other and whose product is better and whose interest rate is better, where that has been something that outside of the mobile phone and making that available to them, before they didn't have choices. So very interesting.
Yeah. Ineke, Aisha mentioned something interesting. She said that we went the VC route, venture capitalist route. That's what banks are actually coming up against.
I don't think so.
You don't think so?
Banks typically do not finance startups. I think, and you know, the evidence is there. If you start up a business, you start up with either a little bit of your own money or friends and family. Sometimes you have to explain the bank's money is not the bank's money, it's the depositor's money. And the bank has a fiduciary responsibility to make sure that that depositor's money is actually there and is being lent sensibly and responsibly. So therefore, if there is no history, you know, it's very difficult for a bank to lend. So any startup, I would say, yes, start with friends and family, or start VC.
And once it's working, then
and
come
once
to
it's
you.
working, once you have a little bit of history, once there is a little bit of cash flow, of course that's when the bank comes in.
Uzoma, are you willing to take on the risk?
Well, I think now we can, I think before it would, so like when we started our small business proposition, it would take about a year before we would start lending to customers because we didn't have enough data or information to do that. Or we didn't have, should I say, collateral. Now, you know, 10 years on, I think first of all, we now have better data points that we can use, and I think it was mentioned here. So we use things like utility payments, even like your social information to come up with more a better scorecard. We now have a collateral registry that allows people to register almost anything that is of value to them. So that means that we can now, we're now more responsive at lending. So I think we start off with, you know, working capital first based on your transactions. And it all forms part of that financial development and literacy where we say, if you make all your payments digital, through your bank account, so we can see the type of transactions you're doing, and we can help you, and we can also provide working capital and help you grow through the period. So I think now we have more data and more information to make better judgment faster and quicker for small businesses, and it's now what's bringing them into the banking cycle.
One person that might have the data you might need is Stephen, because millions of people have SIM cards. You're aggregating data constantly. How can we make data work for banks?
Well, I'd like to go back to the earlier discussion, because I think both of us violently agree. Telco shouldn't be providing banking product. They should be enabling it. So I think you're spot on there. Otherwise, you will get substandard products. So I'm definitely not suggesting that banks should be doing loans, and I mean, telcos should be doing loans and savings. That would be a disaster. But there's a lot that we've got that we can enable, and you can take the friction out the system. I was with MasterCard yesterday, and they were saying they did a study in South Africa, and cash cost this economy about 52 basis points of GDP a year. That's a huge amount of money. And so if we can create, two things. If you think about what banks are doing and what telcos are doing, is every time we do a new transaction, we do a whole lot of identity, whether it's KYC, FICA, RICA. If we could share that, or even if government could provide that, like the Indian government have now done, and we're doing in South Africa to a smaller extent. The other friction in the whole system is the payment system. It takes, there's lots of latency, 24 hours, 48 hours, very expensive to connect. And if you're not using identity, data, location, the fraud costs are high. So your card costs are anywhere between 3 to 7% of a transaction. So you can see if you start mixing all these into, let's call it banking cost, if your financial services cost, that's what you have to take out. And then if you could take, if we could have a partnership with a bank where I could offer to our clients, do you want to give this information to a bank? Because what do you do when you go and get a mortgage or a loan? They ask you for 6 months bank statements, they want to know where you live, they want your utility bill, they want to know who you work for, they want to know how long you've worked there, they want to see salaries, etc., etc. We've got all that data. And so the ability to work together to actually provide that as a package, at your option, I think is very important. It's just some of our regulations don't allow us to do that right now.
Yeah, and some countries are a lot more regulated than others. I mean, in East Africa, we know that M-Pesa and Safaricom trumped the entire banking system as well as the regulatory environment. What do you think should come first, Ineke? How do you think it should be formulated so that there are synergies between all the stakeholders involved?
I see the synergies happening, actually. You're right. I mean, the telcos have a lot of data. When people have a telephone card and a SIM card and they've registered, that could be the data you need to open a simple bank account. And that's what we're looking at. Just open a bank account and your telephone number will be your bank account number until you reach a certain threshold. And when you've reached that threshold, and whatever amount that is, you're required to go to a bank branch and do a full KYC. Now, that would mean that a lot of people would be able to just open simple, low-cost bank accounts, and for the banks to basically use the derivative identity check that currently the telcos are doing. To me, that is a way to move forward and to be able to enable a lot more people to open, relatively simply a bank account.
How well is your Chap account doing at the moment?
Yeah, that's one of them. Chap is what I just mentioned, where we go to the fields, to the people, to the farmers, and open for them a very simple, relatively low cost. Chap means quickly, so it's a quick opening of a bank account. You don't need to go to a bank branch, and it's an ATM card is connected to it, so you can go to an ATM for cash in and cash out. And that's the bank account that we want to reach a lot of people with, and we will going forward. If I may, we just opened another type of, or actually we're piloting another system which we call an Kilimo account, and Kilimo is the Swahili word for agri. So this is typically for farmers who right now do everything they do in cash. There's some big buyers who've said, we would like farmers to be able to receive the proceeds on bank accounts or on M-Pesa accounts. We would like directly to pay the buyers, the farmers, but also to make sure that they build up some credit history. So for the farmers, they can go onto a platform, they identify themselves, they sell their produce, they sell their coffee to a large trader. The trader will immediately credit their bank account for the amount of coffee that they have sold, that the farmer has sold to them. And the farmer, again, will be building up credit history, but also has transparency about the pricing of the coffee that they can be selling to a large trader. So it's all these simple, using data, using technology, using digital identity, that is going to make all of this possible.
I'd like to get a sense from you, Darlene, what are the needs on the ground? So we've heard some of the solutions that are coming through from the big players, but what are you hearing from entrepreneurs? What do they need?
So, I mean, in South Africa, the 3 big studies done last year, National Small Business Chamber, SAICA, Seed Academy, access to finance is obviously the big challenge. So, access to market is the other one, but I mean, you can have a great car and a great driver, but if you've got no petrol, you're going nowhere. So whether it's a startup needing startup money or a growing business needing to, expand, or working capital or cash flow bridging. And so then if you work backwards, why are they not getting that? Well, the one thing is the credit score, but the other thing is readiness. So lenders have money to lend in this country. There's actually a lot of money available. Obviously, banks and government grants in terms of startups is a very small share of that, but there's a lot of players. The problem is readiness. So they don't have their financial statements, their management accounts, their the rigor that's needed, their company registration documents. So readiness training. So it's not only finance literacy that they need to understand. A lot of guys on the ground are turning over a lot of money. They don't even know what collateral means, etc. So it's getting that broken down and people understanding those things. But also the accounting side of it, the readiness side, is a massive systemic blockage, not only in South Africa but across the continent.
And first-time borrowers, I mean, are they being pushed aside by the banks? as Ineke had said, you don't go to a bank if you're looking for first-time credit. That's just not what you do.
Absolutely. In this country, in terms of the early stage, banks look after less than 3% of all the money that's loaned to startups, government about 4%. So as someone said earlier, family and friends, there's the saying family, fools and friends. In South Africa, it's about 94% of how startups, both of us sitting here lost our homes, our cars. I liquidated a number of times before, and that's all taking your own money because you have a belief, you can see that there's something that you can change the market with, and you do eventually get there. But I think some of the players on this panel could make that road a lot easier. And what I was saying earlier was that corporates and entrepreneurs need to be working together. Corporates can't make products for entrepreneurs. I was saying earlier to Stephen, it's like someone without children writing a book about how people with children should bring up their children. Corporates need to work with entrepreneurs to understand the needs on the ground and make those products in terms of credit or any other requirement. But I think finance readiness, finance literacy is a big piece of financial inclusion.
We know that entrepreneurship is going to propel the continent forward. That's no mistake. That's no secret. But if you've got the banks not willing to take on risk, that's going to stymie growth. That's the reality.
I think the idea of risk also needs to be redefined, right? Yeah. So, we were talking earlier about an entrepreneur who transacts not necessarily in a way that the bank can see, but is very responsible with their money. The idea of risk needs to be redefined, but then also financial products that are made available to entrepreneurs need to be appropriate to the stage that entrepreneur is at. Mm-hmm. And so starting with a very low-cost bank account initially that has, low transaction costs, is very easy to understand, doesn't have complicated products, but then graduating as you make more money makes a lot more sense than, using the same kind of risk profile to assess a range of entrepreneurs at different stages.
Stephen, I saw you wanted to jump in there.
I think we need to be quite careful here. Banks are debt providers, not equity providers. Our regs in most countries determine that. To take equity risk, a bank must hold 4 times the capital. So if you just impute that into a bank cost, a bank just let's use for ease, and South Africa is probably raising money at 7 to 8%. So if you've got to hold 4 times the capital, your starting point is 32% interest, which, as we know, compounds badly. So that's the issue. It's not about banks wanting to take risk or not. It's their ability through regulation to take risk. And if you want to have a balance sheet full of entrepreneurs' loans, which affect as equities, because it's a new business, it gets very difficult for a bank, and you'll bring the banking system down. So we need to get a balance. I personally believe what we've done in South Africa with that CEO forum, where actually the banks have put some money in, but it's largely corporates who've contributed into the SME fund, because I think there's actually merit today in corporates stimulating product for their clients and product for their businesses. And you can do that by assisting, mentoring, supporting, educating, as well as providing some equity to an ecosystem around your business. And I don't think, personally, that's been explored enough.
Yeah. I understand the fiduciary duty, I understand capital adequacy ratios, I get that. But we keep talking about what's going to grow the continent, but there's a disconnect. So who's going to step in? Is it going to be the VCs? What's going to happen? How are we going to make a change?
So if we look at the Nigerian market, there's 17 million small businesses that are unbanked, first of all. So I think Darlene mentioned it here, that beyond the access to finance, and so if you look in Nigeria, there's lots of money everywhere for small businesses. But what you find is that the average lifetime of a small business is very small. So how do we now create an enabling environment for them to be sustainable? I think that's a key fundamental step. So it is readiness for capital. It is also access to market. So it is. So I think it is a new model, a new approach that is needed. So, for example, in Diamond Bank, we work with capacity building organizations to help small businesses grow capacity. We also try to create access to markets. So we have 12 million customers in Diamond Bank. How can we connect our small businesses to our market of consumers so that they can be sustainable and they can be sustainable and grow, and we can lend working capital through that. So the opportunity is there, but I think the bigger issue is how do we make sure that readiness, they're in a fit state to lend, so that they can grow through that and not actually plummet through.
And spending a lot of time in Nigeria, speaking to entrepreneurs there, they are the most resilient because they literally start with absolutely nothing. And when they do get credit lines, we're talking about 35, 40% interest rates. And failure rates are really, really huge there as well. So how are we going to make things easier?
So I think we get bogged down with interest rates because first of all in Nigeria, so the alternative for them is actually 10% per month, which is about 120%. And so when they come to a bank, that rate is actually reduced. So what we try to do is, what is your cash flow and what can you pay back? So if we get bogged down with interest at 35%, Nigeria's inflation is at 18%. So real interest rate is about 12% really. So but for us, it's not the interest rate, it is how you use credit. So if you borrow money, if you borrow a million naira for 1 year without paying back, that's 1.3 million, which is huge. But if you borrow when you need, if you borrow for half the year, it's half that amount. So the effective cost is 17%. And that is that financial education that we actually go along with our customers, saying we will only lend to you when you need it and not because you want it.
Yes, Dali.
I think the other thing you're asking, who's going to solve the problem? I think we have to understand that we need data. So the telcos have data related to the use of mobile, and banks have data on what they know about their client. But I think where the big gap is, and this is where we're trying to look at, is actually leads management for what do people want? Because I think that not only banks but other people that are creating financial products don't have enough data on the SME to know what they need, where they're at. So you need to know which sectors are the problems, which geographical areas, how much, what is the average loan size that someone in the tourism sector in South Africa needs. So a product that we partnered with government on to put out is actually collecting that data. It's putting a carrot out to an entrepreneur in a free website to say, listen, there's a whole bunch of lenders here. They've got a lot of criteria. It's like the Tinder for SME. You tell us what you need and we'll tell you if we've got someone that matches you. So you get someone coming in saying they're a black woman-owned business in a certain province in the construction sector. They turn over 5 million rand. They're needing R1 million worth of whatever type of capital. And then you can start to match them up. What we're starting to see more than the matches, where the gaps are. And so if you're asking who's going to come in, they could come in and actually look at what should they be tailoring in terms of a product for the startup market. Like I said, what are the different growth levels? And so I think data plays a huge role, not the data only about the way that you operate your mobile account, but what are your actual needs? Where are you in the business life cycle? Because that information is becoming hugely valuable. And we're keen to work with like the SME fund, because here's the data on what's needed. You've got the money. Now let's start to craft the products that can actually meet those needs.
I like that idea, the Tinder for entrepreneurs. Stephen, is this something that you'd be willing to help create?
I think what I'm very interested here is that we're talking about enablement. And enablement isn't just giving someone a check. Enablement is a whole lot of things: education, data, support, getting involved in ecosystems, being able to actually access corporates. If you have a look at MTN, 22,000 people. If you want to now come and do something there, you've got to try and find your way through the corridors. It's actually quite daunting. And so enabling entrepreneurs, creating those systems, creating those ecosystems, I think is critical. I mean, I'll just give you a quick example. I was, in my past job, we were involved with Care International, who basically create mini or real actually peer-to-peer lending, many building societies in the communities, where the communities lend to each other. And what's interesting is mainly women, because they're obviously trying to do businesses in there, but they charge 10% interest per month. And I asked them, why do they do it? And they said 2 reasons. One is it's easy to calculate, but 2 is, the more important thing is, when they're sitting there as a 30-person community or ecosystem, their decision they have to make is, if I lend my money to my peers, I can double my money in a year, and I don't have to do anything. Or I can borrow the money from my peers, and I have to really put it to work because I've got to double my money before I make a profit. That's a cool decision point. And so some people are risk averse and say, I'm happy to lend it to my peers and double my money, and that's cool. And other people say, well, I can actually do better than that. I can go and start a little store, I can do it on the roadside. I mean, this is real grassroots stuff. And I was fascinated by that actually this interest rate is not the big issue. It's the access and the ability to get it. So going back to your family and friends thing. And so it's this enablement system that if we create, you then create, and you know, in that little village in Kenya, they had saved over $1 million between about 600 of them in the last 2 years. I mean, it's fascinating. And so one needs to sort of understand more, you know, what entrepreneurs really need to be successful, and it's not just money.
Ineke, I see you agreeing there. And you know, there's so many, I mean, what Stephen mentioned, there's so many examples like that in Nigeria, the sort of the informal savings sector, Ghana, you know, what is the trend in Tanzania?
Savings is actually very important, and creating more a savings culture is very important. And, you know, mentioned CARE. We've worked with CARE in Tanzania, and what CARE was doing was all cash. It was all these communities were doing it all cash. So we've worked with CARE, and we've created a product which actually moves it from a cash product into a bank account product. We call it our Pamoja product, which means together. So rather than these people all doing cash, they put that money on an account, they have one joint account. Rather than having 3 people have the key to the cash box, we'll now have 3 people have the digital key to the joint box. And this creates in this community, and it may be 30, but it may be 300 as well, again, the ability for people to have an account, to work with that account. What we've created is for anyone having an account, an individual account, for transactions between the individual account and the joint savings account to be at no cost. So it creates something which, again, digital, financial inclusion, credit history, well, in this case with the help of CARE, and I think those things are scalable. So we should much more do, and saving. Saving is so important. And to talk about youth and to try to create even a savings culture among the youth, because any child who maybe starts saving a little bit when they want to start a business when they're 22 will have a little bit of their own money to start a business with. And that savings culture is not around. And I think we cannot emphasize enough how important it is to start a savings culture.
Yeah, you've got to be earning enough, there's got to be an incentive, it's got to be cheap enough, all those barriers to entry, Uzoma.
Yeah, so I mean, like, interestingly, like, we have a use case where we're working with Women's World Banking, so it was how do we bring more women into the financial space, especially in the marketplace. And so we developed a product called Better Proposition, which is a better way. And what we actually were doing, we're actually displacing the traditional way of the Ajor system, which was a man who would come, collect money, lend them money. The problem was that sometimes he would run away, so they would lose all their savings. And so what we did was actually displace that using we employed new types of bankers called better agents, who went into the marketplace and would open accounts for them, a mobile banking account, a full mobile banking account for them. They would collect money from them, and they would get a notification, and they could also give them cash as well. And so what we've seen there is that, first of all, the transactions are very, very high. Being at the bottom of the pyramid doesn't mean that you're poor. It just means that the bank haven't actually been responsive enough to create a solution for you in that manner. So we've used mobile and digital to actually transform a traditional financial method that was riskier and wasn't cost effective, and now it's actually beginning to change the lives of the people. And the second part is the Isusu, which is group savings. So what we've done there too is made it digital, and so the idea is from your savings account, you can either save on your own or you can save with a group of people. But what it does, it gives you, instead of giving you an access to people just near you, it gives you now access to more people who actually want to save. So that's a way of also bringing people in. So why should you open a bank account? It's because you can actually keep doing the things you were doing before, but now safer less risky and more cost effective.
But what's the uptake been on your better proposition?
I mean, so it's been very huge. So on the better, for our better customers, in 2 years, 500,000 customers have over half a trillion in deposits. Now this is much higher than our mainstream banking. So there is business at the bottom of the pyramid, but then you just have to understand the way they want to conduct their businesses and build solutions around that.
Is there money for you though? Is there an incentive for you to go into it?
So it's always been, so we've always taken the approach it was a sustainable business, and so it's not CSR. It's a full-fledged business model that is successful, and we're beginning to see competition coming into that space now.
Yeah, we see the same thing in South Africa. So, very low-cost banks, South African banks setting up very low-cost bank accounts. With our business, one of the things that we do is that when domestic workers come and they get onboarded onto our platform, we have one of South Africa's banks, FNB, come. They have a R5 a month bank account, which is a couple of cents a month, and they come to our onboarding sessions. They understand the importance of getting these people using low-cost bank accounts. They start banking with FNB. And then as they start earning on our platform, they can graduate to kind of more expensive and banks or bank accounts that offer different products. So then they can get access to a loan for a mobile phone or for a more sophisticated mobile phone. They can use that phone then to buy electricity and airtime, etc. So I think it definitely does pay off. People they need to kind of start small, but then as they use the bank accounts more and transact more, they bring in more revenue for the banks for sure.
I'm going to gauge from the audience now just to see if there are any questions, and there are a few hands up. Madam, there will be a microphone, roving mic. Kindly introduce yourself and pose your question. Thank you.
Hi, I'm Jules Newton from BTS in South Africa. I'm hearing a lot about financial literacy education as a need and business acumen for small businesses. And I know in South Africa, the Financial Sector Charter compels banks to spend a certain % of net profit on educating their consumers and potential consumers. And I'm not sure that legislation necessarily exists in Tanzania and Nigeria. And I'm just wondering how you approach that. Do you take responsibility for educating your own potential customers, or is it done differently?
I'll take another question.
Well, I'm Markus Seidel, a social entrepreneur from Germany, and listening to the discussion, I asked myself, what would Edward Snowden say? And he would say, maybe you guys, you're running very, very fast into this fourth industrial revolution, and you don't care too much about the basement that you're running on. It's, of course, the internet. And if it's about banking, this is a very serious issue. The internet addresses are provided by ICANN. ICANN is an US organization. And you have this Patriot Act there. And you know what a combination of a Patriot Act, an organization in the United States, and maybe weird president could be in the end. So I would ask you maybe, care about the basement, and maybe you ask the United Nations to become the owner of ICANN, so the internet addresses are safe for every country, because otherwise, with the Patriot Act, it might be possible to switch off a whole economy in a country. Maybe you care about that?
Thank you. Well, yes, sir.
My name is Austin Okere. I'm an entrepreneur and resident at Columbia Business School. And bringing it back to youth banking, I mean, if you look at the 5 forces model for analyzing the future of banking, you see that if money goes digital, then the fintechs are going to be the face of the new banks. And it seems that money is going to go digital because whatever the youth are doing is now digital. There have been the successes in Persa, but even much bigger successes in China. China is by far the leading fintech capital of the world. Ant Financial, Alibaba's Ant Financial, valued at $60 billion, as big as UBS in Switzerland. And their fund, leftover fund they call it, has 165 billion in it, bigger than the 150 billion of JP Morgan's US market money fund. But my worry is that if fintechs become the new banks, then the regulatory regime becomes a communication commission, not the central bank. And this is where the problem is, because then you're going to have an imbroglio where the biggest bank, as is the case in Kenya, M-Pesa is controlling 44% of the GDP, is under the control of the Communications Commission and not the Central Bank of Kenya. How do we approach this problem?
Thank you very much. Okay, that's the first round of questions. I think the first question that was posed is about educating consumers in South Africa. There's obviously regulations that banks are compelled to do so. Nigeria and Tanzania, what are the requirements?
Well, there are no requirements, but I think in Diamond Bank we have a beyond banking philosophy that means that you just can't just look at just providing products to your customers and say, okay, here's the product, deal with it. Nothing will happen at all. So new customer segments, so it means that you actually now have to show them how to use it, why you're switching from your traditional method to this new way. So if it's moving from cash to digital, this is the benefits from a cost perspective, risk perspective, and also access to finance perspective. So that cuts across whether it's consumers or whether it's small businesses. So it's something it's built into. So when we're rolling out a new product, you're rolling out how do we train people and how do we make sure that the communication is not corporate speak, but it's speaking to the people that we're trying to address.
It's almost as if you can't market your product if people don't understand it as well.
Exactly.
One goes with the other. Ineke.
Yeah, Tanzania does not have any regulation that banks have to educate their customers, but we feel it's a business case to educate our customers. And in our youth savings proposition, for example, that comes with financial literacy training. So we have 190 branches around the country. In every branch, we have 1 or 2 people who go to local schools and who educate the children and the parents how to use a bank account and how to start saving and use a savings account. So for us, it's a business case and it's very compelling.
Stephen, would you like to take the ICANN?
Yeah, I mean, listen, I'm fully there. I mean, if you have a look at what's stifling financial inclusion and therefore inclusive growth in Africa and any developing country, is the fact we've got first world regulations and all driven out of the USA around anti-terrorism and that. The reality is, you can go to further and say, have a look at what Indonesia have done. They've got 4 levels of FICA, so they've said we need financial inclusion, so we're going to have different risk categories, if I can put it that way, and we all have to just agree today where you've got cash, it's faceless, so it's going across borders in paper bags anyway. And you have a look at Kenya, who said, you know what, we need to regulate this, but actually we need financial inclusion more, so let's get everyone included, and then we'll regulate it. And so I think with the digital economy, this 4th industrial revolution, we're going to have to be a little bit practical to get people included and then regulate it or deal with the fraud and everything, because you can stop it and then you can never regulate it, or you can let it happen and then you can regulate it. So I think there needs to be some real practicality around it, because it is, I mean, if you have a look at the cost of regulation, speak to any bank in South Africa, in any country, it's massive. I was just with Jamie Diamond the other day at dinner, and he was telling me that they've hired something like 5,000 compliance officers, just to deal with regulation. What's happening? The consumer's paying for that. What does it do? It lifts the sort of floor on who you can bank, and so we have to deal with that. So I think it's a great point.
I mean, the point on M-Pesa, and of course, it accounting for such a huge chunk of the Kenyan economy, that it was born and then it was regulated, and no one really knew how to kind of deal with this giant. Do you think that it's negative overall because of the fact that it was tough to regulate at the end of the day?
What's negative, and I'm talking from what I heard from the finance minister of Kenya at Davos, their biggest issue at the moment is they let it happen because it was a great idea. Now they're fighting for interoperability. And that's why Equity Bank got approved. That little sticker they've put over the SIM card is because they're fighting with this interoperability. And so I think we've learned enough over the last 5 years to create a proper ecosystem, because my view is you're never going to get something better than cash if it's not everyone to everyone. The beauty about interoperability is if I give you a dollar bill, you know that's value. digital has to be the same. And if you don't have interoperability, it's not everyone to everyone, and you're actually stifling the economy. So I think interoperability is sort of a basic, government regulation, human right that we should have. And they need to get that sorted as quickly as possible.
And Kenya's not just recently scrambling the banks as well as the central bank to come up with their own products. So let's see how it goes up against M-Pesa. Aisha, did you want to
Yes,
add?
I think this is just a general point about innovation and trying to design regulation around innovative solutions. It's very difficult at the outset to understand ultimately what those solutions will become. And so, I think if we had thought about the Kenyan case and tried to apply M-Pesa to South Africa and what we thought M-Pesa would be, we would have designed very complicated regulation around something that became a non-starter. So, I think innovation kind of has a mind of its own, and people use products as they will, and then the response is to regulate around that, and I think that's appropriate.
Can I give you just one example? I think it's a fantastic point that in this new digital world, if you really want to access it, I mean, there's no secret why there's so much innovation in Kenya is because they've got access to a payment mechanism. Okay? But just from a regulatory point of view, today if you're a bank, if the regulator finds out there was a fraud in your system, they fine you. But in the new world, what about having a regulation that says, okay, you need to look back every 3 months and see if there was any fraud, because it's all small amounts, and then deal with it, and we're happy with that, because that stimulates the economy. So from a risk perspective, we're happy to have a little bit, but you can slowly shut it down by getting everyone on the system. So you've got to almost do it the opposite way around. And we've still got legacy regulations dealing with the new world. Maybe that's a
very good point. Legacy regulations, dealing with the new world. Any more questions from the audience? We've got about 5 minutes left, and then I'll get closing remarks from our panel of experts. Yes, sir.
Hi, my name is William, and I'm from Malawi. I've been listening about this convergence, and I think it was Steve who mentioned about a bank-led model and a telco-led model. I'm just wondering, can it work with the cost of compliance and this new phrase of de-risking that is going on? I mean, when I work in a bank, so when you get an email from a head of compliance at Citibank saying, okay, we've noted this trend, and if you don't change, you are going to shut down your correspondent banking. And in Africa, you can't work without a US bank, otherwise you're dead. So how can this work?
Thank you very much. Uzoma, would you like to?
I think, like in Nigeria, so I think the central bank, I think, had not the first mover, but the best mover with the telco and bank collaboration, and they came up with some rules. There was no exclusivity, and you could work, and it had to be a bank-led model from a banking perspective. And so Diamond Bank and MTN came together and said, how can we come together to bring our solutions together, and key, top in mind was interoperability. So it means we wanted to make sure that it was a full banking account and not a mobile money account, and two, that you can transact with any bank, you can connect with any bank in Nigeria. And I think we rolled out what we call Diamond Yellow. In the first 2 months, #710*, and you can open a full banking account. And we wrote on the back of the SIM registration, which was the KYC. And so now we have like 2.5 million active customers on that network who are actually transferring money, making payments, utility payments, buying airtime, and actually now running their businesses through that. So that is an example of where we've managed to, open accounts without paper, without people coming to a bank, and also them doing it in remote parts of the country that we would never have achieved five years ago. So that's where good regulation can actually promote collaboration between two telcos and banks to bring out the best convenient solution for the customer, and also promote to facilitate financial inclusion.
Fantastic. We're going to have to wrap things up. We've got just a few minutes left. I'd like closing remarks from all of you. And Darlene, let's start off with you. I think what's important to note that some of the things that came up is, of course, education, financial literacy, the regulatory environment. Is it going to be bank-led? Is it going to be telco-led? Financial inclusion, so much room for growth, so much scope to do a lot, and how are we going to get it done? So perhaps some of the solutions you'd like to bring to the table to take this conversation forward, Darlene.
Sure. I think what Stephen was saying about banks doing what they do well and telcos not trying to do that, but then taking in what Aisha said around understanding innovation and actually building the regulation around that. I think there's a big component there for banks across Africa to re-look at regulation and maybe with a lot of collaboration. And again, my passion in terms of financial inclusion is right from literacy, but through to access to credit, and who is going to fill that gap that we were talking about. We know it's not the banks. Government aren't going to do it. Even, some of these funds that are being set up are much more private equity than filling that missing middle that we have. And it can't just be family, fools and friends, as we said. So I think that we need to have a look at data. We need to understand where the gaps are, and someone needs to take a risk. And I think whoever's going to take that step is actually going to take a big piece of the market, and the banks are going to get left behind.
And it seems entrepreneurs right now are taking the biggest risk. Right,
and I think in terms of support for those entrepreneurs, maybe then partnering, as Stephen said, so it's not just about one party taking on the risk, and coupling access with literacy and with education, I think works, but then also being responsive. So, I think the idea of a top-down approach is outdated, and so looking at a bottom-up approach, being responsive and understanding how people are wanting to use financial products, how people are wanting to interact with banks, how people are wanting to spend their money, and then being responsive to that and allowing innovation to happen, and then designing regulation and interventions around that as opposed to the other way around.
Ineke.
Yep. It starts with information and education. And the next big thing is the move from cash to digital. I think I said that in the beginning as well. Cash doesn't leave a history, digital leaves a history. Digital enables banks to actually make credit decisions based on data. And if we don't have that, we're not going to be scalable going forward. Banks will never be scalable in their branch networks. They only will be scalable digitally. And for that, what it takes is for the cash economy to move into a digital economy.
Stephen.
I'll use an Einstein definition of an idiot who says that if you do things the same way and expect different results, you're an idiot. And I think in this world, if we really want to do things differently, and we are, and we can with the digital economy, we need to do things fundamentally differently. And I'd really like to see a lot more debate around building things bottom up. So build it for the poorest person, because then it works for everyone. It's like trying to take a Ferrari and turn it into a Mini. It doesn't happen, but you can take a Mini and you can make it a lot faster. And I think if we can just do things differently, I think this whole ecosystem, getting more people involved, getting big corporates involved, creating the ecosystem so you can teach, mentor, and support, I think is very critical. And I think regs need to think about the future, not the past. Learn from the future, not from the past. And that way we'll move forward.
So I think the financial inclusion problem is going to be solved by mobile, and it has to be digital as well, and which means that it's going to require collaboration from stakeholders, banks, telcos, content providers. When I say content providers, capacity building people, and most importantly, regulators. And I think the benefit would be we would see enhanced commerce across Africa. And one thing that we have found is that the banking in Africa is actually more creative and innovative than other parts of the world, because we're trying to solve that. So we're trying, and that's what you need to solve the financial inclusion problem.
Absolutely, and just speaking to some of the delegates over the last few days, I spoke to MasterCard, and they said they're expecting to get 100 million new customers just out of Africa over the next few years. EcoBank, of course, the Pan-African Bank, 100 million new customers as well by 2020. So the growth is there, they're pricing in the numbers, but the point is, how are we going to make it work for the people right at the bottom? And I think that's the point that you've all made today. And I thank you so very much for your insights and for putting some solutions on the table. And I look forward to catching up with you in the next year to find out how far we've come on some of the things we've discussed today. Thank you very much, ladies and gentlemen. A round of applause for our